Good evening and welcome to this very special episode of The Money Show. I'm Kavita Thapliyal and this is a show, War of Asset Classes. That's right, that's what we are calling it. And who will win 2026? Now, 2025 has been a year of sharp contrast for global and Indian markets. Now, while some asset classes struggled to find the right direction, others delivered surprising returns, testing investors' patience, conviction and strategy. Now, geopolitical tension, trade tariff uncertainty, global macro risk kept markets short on clarity and long on volatility. Indices broke key support levels, struggled to hold higher grounds and failed to show sustained strength at upper resistance zones. Now, equities for much of the year delivered returns closer to fixed deposits, but SIP investors emerged as the real heroes while, systematic investment flows hitting record highs every month. Now, sector churn dominated headlines definitely, and a renewed push towards the consumption theme caught investors' attention. Now, debt markets, after years of tight monetary policy, finally found some relief. We are now clearly in a rate cut cycle with expectation of more easing ahead. However, bond yields and persistent rupee weakness remains key risk, a trend that could very well continue in 2026 as well. Now, but the real jackpot asset class in 2025 were elsewhere. That's right, gold and silver shone bright amid geopolitical uncertainty and aggressive central bank buying. Gold scaled fresh highs and silver as well on an even stronger run. That's what we are witnessing, triggered serious FOMO among investors. Talking about cryptocurrencies, staged a dramatic comeback, ETF approvals and rising institutional participation pushed Bitcoin and digital assets sharply higher, delivering stupendous returns in 2025. Now, once again, crypto reminded investors why it is the most volatile yet most tempting asset class. But then there's passive investing. Index funds and ETF quietly outperform many active strategies, capturing market returns efficiently, transparently, and at a low cost. So, as we step into 2026, the big question over here remains: which asset class will lead the race next year? Will equities make a strong comeback? Will fixed income offer the right balance of return and safety? Will gold and silver continue to shine, or will crypto surprise everyone yet again? Now, to decode this battle, we have an exceptional panel with us today. We are joined by Mr. Sandeep Bagla, CEO, Trust Mutual Fund; Abhishek Hussain, Head of Fixed Income, Kotak Mahindra AMC; Ajit Khurana, Founder, Reflexical; Dharmesh Bhatia, Commodities Expert from Dubai; Chintan Haria, Principal Investment Strategy, ICICI Pru AMC. So, 1 hour, one debate and one winner. Hi, good evening. Welcome all of you. And this is the War of Asset Classes 2026 and we begin right now. Happy New Year to all of you. And Sandeep, I'll come to you first. Are we planning, equities planning to beat fixed deposit returns like what we saw in 2025?
Hi, Merry Christmas and Happy New Year. Thank you for having me on the show. So, actually, if you see, in equities 2025, I was seeing the one-year returns. Large caps are close to 7 to 8%. Small caps are -8%. So this has been quite a tale of two cities. And fixed income has been actually quite good, between 7 to 8% returns have been generated across the short duration and liquid funds. See, I think it is reflective of the situation that we are in globally and in India. In India especially, growth has somewhat tapered. While there is growth in real GDP, the nominal GDP is not really growing. And valuations are on the higher side, from historical standards and in comparison to some of our emerging market peers, because of which emerging markets, the other countries in the emerging markets have fared far better compared to Indian stock markets. So I think one should, remain invested in equities. One doesn't have a choice, but the return expectations have to be lower. I think if earning growth does not come back with a flourish, then equity market returns are likely to be tapered this year also.
That's a take. That's a take coming in from you, Sandeep, and we'll discuss more because I really want to know your house views and your stock specific, your sector specific recommendation. But before I do that, let's go across Dharmesh because Dharmesh, what a year! Gold and silver still shining, and what's the outlook out here? What are you gauging? And yes, profit booking likely to happen in silver, but then the trend is likely to continue. What are you analyzing?
Happy New Year to everybody. Definitely the euphoria is amazing. This year, silver has given 100% more than gold. Gold is around 20-25% annualized return, whereas silver has given 120. And today also fresh high on the silver pricing. Uh, as you know, it's really a volatile commodity, and after breaching the $50 mark, that the way it has gone almost $20 in the span of less than a month. Profit booking can be anticipated, but again, the spot is already in discounted than the futures price. Price is really trading at a higher level. Next year, again, I'm expecting the market to rally further because the way the buyers are showing their interest, especially on the physical side, has gone up really drastically. I'm from Dubai, and in the Middle East, bullion is one of the key resource of trading. As of now, the consumption has gone up really drastically, and as you said, the central bank buying on the gold is phenomenal. To purify gold, you need silver. So again, the silver is a byproduct for the gold, so it's in tangent. For a few years, silver was trading very lackluster, but now it has picked up very sharply in the last quarter of this year, and you have seen the prices at almost about 200,000 rupees in the Indian market. For 2026, I'm very bullish on the gold side. Reason is, again, the interest rate cut. I'm expecting the rate to be very sharpened, and you can see the price to around 2.5% US Treasury, which will give a trigger to the domestic, to the international market also. So gold, you can expect around 4,500 to 5,000 level, which will be the next year target, approximately with 400 to 500 rupees dollar rally in the international. With domestic market and with the rupee depreciating, you can expect the price to go to 150,000 rupees in the domestic MCX price. Whereas silver, it's already it's a lifetime high. Too much volatility can be seen, but stay invested will be my call, and I'm expecting the price to breach around 75 to $80 in coming quarter. In the domestic market, with rupee depreciating, you can see the silver price crossing 250,000 rupees in a coming months. So buying side will be the call for me, and I'm still hoping this price will continue. Barrel can also think about copper also, which is also trading at lifetime high, again supporting the bullion price.
All right, so it's not only gold and silver, it's also copper that you need to keep on radar as far as 2026 is concerned. Abhishek, what's the turf looking like for fixed income for the debt market? What are the signals you're getting for rate cuts, and considering a lot of other factors, we're talking about not only India, even the US market, keeping a check over there in terms of data, inflation and growth. Growth especially stalling out there, but then we also have a new Fed chairman. On the domestic front, we have a rupee that's weakening. RBI is definitely interfering and trying to stop the strength out here. But how is the entire land of fixed income?
Yeah, hi. Thank you for having me on the show, and wish you all a very happy new year. So as far as fixed income is concerned, 2026, we need to carefully watch a couple of events. First and foremost is the trade deal, which is the key driver for the rupee, followed by equity and debt. And then will be the Bloomberg index inclusion, which is due in January. If the announcement likely to come positive, it is going to have a positive impact on the rupees likely to gain. And then followed by the monetary policy. As the other panelists also alluded, that probably the earning growth may not be as strong as it is required. Probably we may be in for more rate cuts, and which the signal will come in the monetary policy. However, if you just observe from the valuation and the reality part of it, if we see the valuations are fairly cheaper, and basically the yields are higher, and the monetary policy is indicating towards softer rates. Market pricing is expecting a fast reversal and probably a tightening sooner than later. But market reality probably is otherwise, which at some point in time is likely to converge in 2026. And therefore, you will see much better returns coming in from the fixed income, which is the clear indicator, if you look at, is the yield curve, which is very, very steep. which is what is indicating that not the rate cuts, probably the rate hikes are going to come in next 3 months to 6 months time. If that doesn't converge towards the reality, then the market yields have to correct, and the long-term yields especially have to ease somewhat from the current levels which they are trading, and that is likely to generate much superior returns, basically the capital gains over and above the accruals. So these are the things which we will keenly watch. Extreme shorter end and extreme longer end are the safer bets, because extreme shorter end saves you from the volatility. But if you are looking for some kind of returns, the returns are not likely to be great, because that is factoring in the rate cut which has already been delivered, and probably one more likely to come. But if you look at just longer end, it is definitely coming with a lot of volatility, but offering great deal of return in terms of real rates and in terms of absolute levels as well, be it domestic or on a relative basis on international space.
All right, so that's a take as far as fixed income is concerned. But then, Chandan, can we call it a year for passive investing and ETF, especially the most preferred way to have in your investment portfolio or strategies?
Thanks, Kavita, and wishing all the viewers a very happy 2026. I think 2026 why was challenging, as you mentioned, apart from those who had invested in bullion, of course. And luckily enough, if someone is invested in bullion, they've made the money. Otherwise, it's been a tough time. Two things have happened. International markets have done well, both emerging markets as well as the US markets and European markets. What has not done well, of course, is the Indian markets or the equity side. However, if you look at from a passive standpoint, we've seen in India a significant growth happening over the last 5 to 10 years. First leg of the growth was from pension funds investing in ETFs after the government allowed in 2015-16. And that actually led to a significant interest from AMCs and the width of products across market cap based, smart beta based, commodity based, and also sectoral and thematic based ETFs and index funds increased meaningfully. So today, if you look at the market in the passive front in India, there are so many differentiated products across so many options that an investor has. Also, much like how India has grown because of the digital stack, the quality or the kind of investors has also increased meaningfully. So we have almost 20 crore demat accounts, 12 crore unique demat holders, and 5.5 crore plus mutual fund investors, many of whom are also getting converted into passive investors. And the growth in the advisory business also and family offices also bringing in new investors in the passive space. So I think passive space along with the active space will grow in India. Investments in general or financialization is growing. And within that, we are happy that in 2022 January, we were able to bring India's first silver ETF, which allowed investors to participate in silver in a simpler manner. Otherwise, it was difficult to participate. Having said that, clearly last 12 months have been tough for Indian equities. And that probably is looking like it will change because our currency went from overvalued to undervalued. Our valuations went from overvalued to probably fair value, if I can say so. And if the earnings growth trajectory, as it is expected in the next 12 months to improve from a trough in 2025, that should also help the equity markets. So maybe in the next 12 months, we will see Indian equity markets at least be market performer or outperform the other markets, while of course silver and gold will continue to do what they are doing because of the investment demand as well as the industrial demand that exists in silver today. So overall, I see the space of passives growing in India, and across passives, all the opportunities or options available for investors are seeing growth, and I don't see that being different. In terms of sectors, etc., if you look at it, energy, oil and gas, tech, they look interesting because they have underperformed meaningfully in the last 1 year.
Ajit, for crypto, the year was not exactly as exciting as gold and silver, but not as boring as equity also, right?
You know what, if my expectations come true, then 2026 will actually be a very happy year for crypto investors. And this is driven by 3 or 4 forces.
Okay.
I was not fully aware of the numbers of mutual fund investors. Chintan just said that. The number of crypto investors was never fully known until 2 years ago because the data was not there. But now that TDS is being applied to every transaction, not just to profitable transactions. We know that the number is in excess of 10 crore Indians. Right? That is a very large number. Of course, you should know that most of these participants invest with very small amounts. So the largest number are from tier 2, tier 3 cities, but the largest volumes are from tier 1, which is in line with what you see in other asset classes. The interesting part about crypto has been that it's an international asset, pretty much like gold is, for example, but the US has taken a very positive regulatory view of crypto since President Trump, who has called himself the crypto president, has come, in office. This, I think, is the single biggest force. It has beaten the emergence of the exchange-traded funds, US spot exchange-traded funds, to be precise. I feel that we should, because of the inflow of institutional capital, despite the significantly irresponsible leveraged positions that a lot of retail investors take and get liquidated every single day, I think we should see a significant returns. And while I don't see myself as necessarily standing for crypto and somebody else on this show standing for equities or what have you, but I think if we are evaluating it 12 months from now, the winner of this war, as you call it, Kavita, is going to be obvious.
I just want to understand, is the number going up because you have an SIP benefit in crypto? Because then the winners would like to divide, the trophy over here, because we know why SIP is famous and how it's famous.
No, as long as you take a view that the asset you're investing in is fundamentally strong and long-term bullish, then the SIP works best in the case of highly volatile assets, and that's where crypto wins. Again, I should warn everybody, especially the ones who are not used to understanding crypto, is that crypto is very broad. It's like saying stocks, and there's a large cap blue chip, and then there's a small cap, micro cap, nano cap. Likewise, I would say that please distinguish between something as established as Bitcoin, secondarily large cap established tokens, and then the rest. The rest are where wild speculation occurs, and the crazy news you hear about crypto is usually from the smaller cap, which together in market capitalization don't even amount to 3%. But that is where a lot of news cycle, especially the negative or scammy or skeptical news cycle, comes from. Bitcoin is not as volatile. It may be only as volatile as tech stocks, for example. And I feel that yes, if you can take a view, either that this is a long-term bullish asset or that you want a certain asset allocation of your portfolio, please come in only in an SIP format, because especially if you have an equities background, your measure of evaluating this asset tends to be like equity, and that would not be fair.
Maybe a part of your satellite portfolio can be allocated towards crypto. But then going back to equity, and Sandeep, I'll come to you now, because see, can we say, Sandeep, that the worst, is behind us? The pain has, minimized a lot, maybe 80% of it. In terms of valuation also, if I want to understand, about 73% of your Nifty 500 stocks are 10% below their 52 weeks high, and the pain is far more pronounced in mid cap and small cap as compared to large caps. Now, can we see a catch-up thing happening in the mid-cap, small-cap space? Definitely, we are looking at the earning numbers. We've seen a single-digit majority earning performance last few quarters. Now, the Q3 and Q4 of this particular financial year are very crucial also, because the kind of push we've seen in the consumption sector. How do you see all of this playing out, Sandeep?
See, the kind of valuations that our growth is being built in the valuations is quite high. In the mid cap and small caps, one is assuming, one is interpreting that there will be, 15 to 20% earnings growth for the next 2 years. That is what the valuations are discounting, and that is why the markets are getting a little disappointed. So there will be pockets of growth. There will be pockets of, better performing sectors, no doubt about it. But I think it's too early to call for, a big bounce back in small and mid caps just because they have underperformed in the market so far. So I think one has to wait. I think the earnings cycle is showing signs of recovery. And I think if earnings cycles recovers a little faster, and like you said, lower interest rates, higher liquidity, lower GST, lower income tax, all should contribute to that. But I think markets might just wait for some more time and see the evidence of earnings to come back before the market is no sustainable recovery.
Can we say that returns are likely to come from selective participation rather than broad-based rally?
Yeah, so I think a few sectors that we are bullish at. We are bullish on capital markets. I think the participation in capital markets will only grow in the coming years. So while valuations, can differ from participant to participant, different types of companies, but I think capital markets is a theme, is a multi-year, mega trend, which is likely to continue for years to come. So that is a theme that we are generally bullish on a multi-year basis. I think another theme, which is slightly smaller, is hospitality. I think hospitals and hotels, people are now chasing experiences in terms of vacations, and they are willing to pay for it. Similarly, for healthcare, I think people are wanting to go to bigger hospitals with more reliable healthcare, and also the incidence of insurance supports that. So I think these are good sectors to invest in. I think the wild card could be metals. I think inflation will markets will be inflationary. Trump is putting tariffs in US, and what was selling for $100 probably will sell for $120. So there can be no doubt that it will be inflationary, and which is why probably one of the reasons why gold, cryptos, and longer-term bond yields are all going up. So one side effect of that could be metals could do well, and metal stocks can do well. So I think that could be the wild card for 2026 for me.
Interesting. Chintan, now carrying this conversation forward, now what part of equity would you prefer a passive investment style?
So if we look at from a passive investment style within equities, clearly the 500 stock portfolio, which is the wider portfolio, is a super portfolio for someone looking at doing SIPs within the index funds, because you get the entire market virtually as part of that. And apart from that, of course, the standard products like Nifty and Nifty Next 50, if you look at the Next 50 index for that matter, that's become relatively cheap versus Nifty, and the construct of the portfolio is much more broad-based. So from a valuation standpoint as well as from a construct standpoint, the Nifty Next 50 or the Next 50 index can be looked at for those who are looking at additional exposure this year. Also, if we look at from a sectoral standpoint, as I mentioned earlier, clearly the energy, oil and gas, power, and tech space has underperformed meaningfully. And to that extent, the technology or the IT index, the oil and gas index, is something which can be looked at. Apart from that, gold and silver, as we've been mentioning earlier, it's better to have a 10% exposure of the overall financial assets to gold and silver. 6% in gold, 4% in silver is a good number. This number, of course, in your Mahakums, which we have spoken earlier, was 15% about a year back, but it has been scaled down to 10% because gold and silver have done phenomenally well in the last year. In fact, 2025 was the best year for gold and silver. Way back 1979 was the last time that they performed so well. So we are talking of a 45-year history being broken in terms of the performance of gold and silver. So to that extent, coming down from 15% to 10%, those who had actually reached 15% makes sense. And having an overall portfolio allocation more tilted towards Indian equities today, especially on the larger cap side, would make sense, because internationally, if you look at the last 1 year, everything has gone up. Global equities, emerging market equities, European equities, real estate globally, other asset classes which are available for investors to invest, and of course, gold and silver. Even platinum and palladium have gone up. They are not investment horizons in India in terms of ETFs there, but they have also gone up sharply. So net, if I look at it, we've been in a world where money printing and the expectation of debasement of currency has led to all asset classes doing well in the last year or so. There will be a time probably after 6 months, 12 months, where there's something becomes more volatile, and all the asset classes will also kind of see a correction phase. So from an investor standpoint, the best thing is asset allocation, and to that extent, the multi-asset funds or the asset allocation category becomes a good fit for the investors in general. However, of course, from an ETF and index fund side, you have the wider range, but stick to the large capish portfolios as a large part of your investment, and cap your investment to gold and silver to 10% is what I would suggest. Thank you.